Canadians have started defaulting on their car payments. What is next? Is it their home payments, their mortgage payments? Where does this thing stop? That's the question that we're going to be asking today. We've got a ton of data to get through towards the end of this, so please stick around. Let's get right into it. More Canadians falling behind on car payments after big run up in auto prices. And you can think of this bubble that has formed within the auto industry and the auto sector, the car bubble or whatever you want to call it. It's so similar to the subprime mortgage bubble of 2008, because you're going to have a ton of people with these subprime car loans that are upside down on it, essentially, where they owe more money than the car's worth. And the lenders were just unbelievable during 2020 and 2021. And it was bad anyway in Canada. So it's just when it comes to subprime auto loans, because the big banks just love them. So delinquency rates for auto loans are now through pre-pandemic levels and likely heading higher in 2023. Paul Holden, an analyst at CIBC and lead author of the report, said on Wednesday. The average size of auto loan increased with higher prices, contributing to higher monthly payments for borrowers. Inflation, interest rates, and economic pressures are making these higher payments harder for consumers to afford. And, you could apply that same statement to people not making their mortgage payments because of inflation and interest rates rising on all their other debts. So it's a recipe for disaster. And first, people stop paying their credit card, they stop paying their auto loan, and then eventually it leads to the obvious, which is they stop paying their mortgage, they stop paying their rent, and it just creates a massive economic crisis, which we've seen play out in 2008 in the US. We know where this ends. With some household budgets stretched beyond their limit, Canadians are having to choose which debt payments they make and which ones they fall behind on. That just kind of summarizes debt slavery, doesn't it? You just got so much debt, you're choosing between which debt you are going to pay off and which debt you're going to default on. But think about it. All the debt that will be destroyed and all that debt that will be defaulted on actually means deflation in terms of asset prices, as that is literally the currency devaluation that the commercial banks do in reverse. It's actually appreciating because they're destroying the money supply. And a lot of people don't understand that it goes both ways. It's a two-way street. So let's see what else they're saying here. Typically, when consumers are in a very tight spot financially, they stop making payments on things like credit cards, lines of credit, and personal loans long before they would ever do so on secured debts like a mortgage, their rent, or a car loan. So they've thrown car loan into that bucket as well, which is interesting. So how long for the mortgages then? I mean, it's not going to be long, I don't think, at the rate we're going right now. So that's really interesting because that guy works for some company that deals with consumer insolvencies by the looks of it. CIBC says the average Canadian still has some excess savings set aside from the pandemic, but it's growing more concerned about lower income households' ability to keep up with payments. And what I would be more concerned about is the rampant fraud that we have seen within real estate, auto loans. It's just unbelievable. That is the most concerning thing to me, and it's one thing that is really tough to measure, but judging by what I've seen on Reddit and judging by the stories that are out there and how organized this fraud is, it's likely rampant. So anyways, let's take a look at that household saving rate. So you can see, obviously, the transfer payments and the stay-at-home orders and everything like that created this savings rate to spike upwards like we saw in 2020, and then it's kind of just come down ever since then. And now you're kind of at a place historically where we've been before, around 2015 here. But if I pull out this chart to the maximum, you can see that we're nowhere near where people were during the 80s, which was after the big inflation run. And, that is just not a good thing. So the other thing that I want to highlight is a lot of people point to the savings that consumers have, but most of those savings are on the balance sheet of people who have more money and more assets and are just richer. So a lot of people accumulated a lot of wealth. There was a massive wealth transfer that happened during 2020 and 2021. So just don't get led into the trap to believe that all that wealth went to the lower incomes and they have this savings pot just ready to go. It's just not like that at all. It's all held on the people who are richer, have higher incomes, and that distorts the picture because it makes the savings look better than they actually are. And I think that's worth mentioning. Canada has no data on this, but I'm sure it's the same as the US. So this is the ADESA used vehicle price index, and you can see that this thing is coming down. Like, you had this massive spike in car prices, used car prices, and now it's starting to come back down. So that's not really a good thing when banks have got all these loans that are on their books for cars at values that no longer exist. And just heading into an economic crisis or a recession with that recipe in tow is just not good. It's just not good. And it's not just that. They've also got the same happening with real estate. So just a recipe for disaster, like I said. And then the other things that I want to show you is we don't have the data here in Canada, but we have the data in the US that we can look at. Delinquency rates on consumer loans from commercial banks is really interesting chart. So when did people start defaulting on things like auto loans and personal lines of credit, those types of things? And if you look at this chart, it really started in 2005 and then it just ran up and absolutely exploded, and it eventually peaked out in 2009. It took a long, long time. And this is the thing, it can take a long, long time for these bubbles to squeeze out, and the banks can be looking at losses for years and years after, which means even if the Bank of Canada or the Fed lowers rates exactly like they did in 2007, then guess what? It doesn't make a difference because the banks, they don't want to lend. And the Bank of Canada and the Fed, they don't control the lending. They can control the front end of the rate, but they don't control the actual lending. It's the commercial banks. And do they want to lend? And the reality is, when they're dealing with so many losses, they're not going to want to take on extra risk. So they're not going to want to lend. And then that puts you in this loop, essentially, this self-reinforcing loop where prices go down. Essentially, more people just start defaulting. The bank is stuck with even more losses. They don't want to lend. Prices go down even further because they don't want to lend. And you just go round and round and round until eventually all those losses have been covered. And even with a government bailout, the government isn't going to be able to bail out all of these loans. No way. They'll keep the financial sector going, but they're still going to be looking at absolutely massive losses. And I really hope that if the banks do get a bailout in Canada, I think it will be a disaster for so many reasons, but if they do get a bailout, that they split the banks up and they divide them up, and they make, instead of having 5 big banks, you've now got 25 smaller banks, and that would really just up the competition in Canada and change things, because the bailout process, or even the bail-in process, is essentially just a government takeover of the banking system. So that is what is going on there. So, and then if you look at single family homes and when people started defaulting on the loans with single family homes, and it was really in 2006. So it was around the same time, give it a couple of quarters, maybe 6 months difference between when people started defaulting on their mortgage to when they were defaulting on all the other types of loans. And also another thing that I want to outline to you is we're up near 2%, they said in that article, for auto loan defaults. Well, if we look at this default chart, where did they come from? They came from down here in 2005, and essentially they were at 2.69, and that was a low. That was a low, and this wasn't for auto loans. This is for other different types of loans as well. But you can see that they came off a low, and that's essentially what I wanted to show you guys, because you know, you get all these things that delinquencies are at a low right now, but look where delinquencies have started rising from every time in this chart. They've always started rising from these lows. So when you're at a low, you shouldn't be singing, oh, we're at a low, everything is fine, the economy is great. You should be thinking, oh dear, we're going to see some delinquency soon enough, because it's inevitable. That's what's happened in the past. But no, they think it's an excuse to say everything is okay, the economy is booming. You know, the Bank of Canada is just completely asleep at the wheel. So is the government. None of them have any clue what they're doing. And I have no faith in them. I don't know about you. So anyway, if you enjoyed this video, you might like this video here. I did this video recently about the auto loan bubble that we're in. And also you might enjoy that video there. Thank you so much for watching. Thanks for all the support. And I will speak to you in the comments below. Take care of yourselves, guys.